Welcome to this first edition of Equitorials Markets this week. First of all, wish you all a very happy new year. Across the world, this is the time for celebration, festivities and joy. However, if you are an investor, there's very little reason for you to celebrate. This year was marked by bad news throughout the year. There were news of defaults, tsunamis, scams, inflation, crises. Now, accordingly, our Sensex lost 1/4 of its value. And we at Equitorials are very happy about that. Not because it resulted in a loss of wealth, but because this has again, and maybe for the last time, given us to pick stocks at throwaway prices. This year saw some extraordinary things happening across the globe. The US nearly defaulted, the European crisis went from bad to worse, a former union minister was put behind bars, and the entire Arab world was swept away by revolutions. Now, the US markets emerged as the best performing markets of this year with almost flat returns. Now, there was a sense of irony in this too. It was the US that nearly defaulted, not India, and yet it is the Indian markets that are down and the US is flat. The Indian economy was marred by high inflation throughout the year. The GDP fell dramatically over the past 3 quarters. Foreign investors pulled their money out of India after the government's inability to pass its own retail reforms through the legislature. FII sold 2,500 crore rupees worth of stock this year. As a result of this capital flight, rupee fell to 54 rupees to a dollar, which is its historical low. Towards the end of the year, the food inflation fell to below 1%, and there are hopes that overall inflation will come to around 6% by this March. Going ahead, it will be the GDP's growth rate that will determine which course our markets take. However, for now, the consensus is that the first half of 2012 is going to be challenging, with any recovery coming only after that. At the beginning of 2011, we were worried about the markets because judging by the valuations at which they were trading, it seemed that the investors had forgotten completely about the present prices. However, now the markets are at much more reasonable valuations and the crisis itself is 4.5 years old. We think it is about time that the economies come out of this crisis now. If you were to ask us, will the markets go down from current levels? Maybe, maybe not. Historically, the markets have bottomed out at a price to earnings ratio of around 10 to 12. Currently they are trading higher above that, so there is still room for correction in the market. But if you were to ask us whether the markets will rise significantly from these levels, definitely yes. Will they more than double from the current levels? Definitely yes. In any case, even though the Sensex might not have bottomed out as per the historical valuations, there are individual stocks that are now at their historical lows. Overall, it is the classic case of limited downside and unlimited upside. In the end, we would like to leave you with a thought. What if you as an investor had a time machine? Wouldn't you like to go back into time and buy stocks at prices 10 years ago? Well, this market fall has given you exactly that opportunity. It has given you the opportunity to go back in time and pick stocks at their historical valuations. All you need to do is come aboard and go on the shopping trip of your lifetime. Happy investing and see you next week.